Yeah, I believe in you. I don't believe in lucky sevens. I'm not sure about Loch Ness, but I know I believe in angels. I believe in happiness.
Good evening, everybody. It is wonderful to see you this evening. Boy, oh boy, is it hot here in the Southeast, let me tell you. So I have learned, with the Tesla, as many people know, Tesla has like a glass roof to it. And I actually called somebody today to see if I can get some tinting done on it, because when your windows are not tinted with that glass roof, it's like you are glowing. Everybody sees everything you're doing in the car, which you're just sitting there driving, right? Like, who's really doing anything in the car that they shouldn't be? So what I was going to say about that is that everything gets so hot because of the glass roof. And when I get into the car, it's like totally over dramatic. It'll say temperature is 105. And I'm like, calm down. It's not 105. And it's giving me the outside temperature, not the inside temperature. And I'm like, this is ridiculous. So we got up to 93, but it's actually a dry summer so far here in Atlanta, and I'm enjoying it. Like, I like that dry heat. It just feels good. I want to get out there and move around in it. So I hope that you're having a really good start to your summer. And I don't want to keep them waiting any longer. Tonight is the news with J.C. Schweingrouber of Vista Partners. And here he is. How are you?
Hey, I'm great. Hey, happy summer. It's finally here.
I know it is.
Yeah, I know a lot of people complain about the heat, but it's like, I don't care. Like, in about 6 months, it's going to be 30 degrees. I'm not going to be happy then either. So I think I'd rather sweat.
I don't even want to talk about that. Let me tell you. So I know, we do this show often, and you give everyone so much wonderful advice and knowledge and education. But this time, I want to start with asking you to tell us about Vistafront Partners. What is it that you do there, and how can we contact you?
Vistafront Partners, we're an investment advisor company. So essentially what we do, I'm an investment advisor, and I'm the co-owner of the company. We actually manage people's portfolios for them. So whether they're saving for retirement, they've left a job and have to roll over their 401k or 403b, or whether they have just non-retirement money that they want to invest, or whatever strategy they need for growth or income, or saving for a child's education, any number of things that you're saving for or investing for or planning for in the future, we actually proactively manage our clients' accounts for them based on what their needs and expectations and timeframes and risk tolerances and all that interesting stuff that we learn about them. And we actually provide management services and for a fee base, and do our annual portfolios reviews with them each year to make sure they're still on track with what they're doing. And we actually can we help a lot of clients that have money outside of what we're doing too. They may have 401ks or retirement money where no one really kind of helps them plan with their families or individually. So we actually review our portfolios, everything with our clients, to help steer them in the right direction of where they want to be 5, 10, 15 years from now. And love the work. I've been doing it since I got out of grad school. So that was my first job, was getting into this business, and just really loved helping people. I like seeing people succeed. Failing to plan is planning to fail, and we've always heard that mantra. And at Vistafront Partners, that's a thing we want to get people to do, is get some skin in the game. Let's start looking at your future, start planning for what you want, what you need, and make sure you're on the right track and keep you on the right track. If you don't watch the road where you're steering, you're eventually going to go off, right? So that's our job, to keep people between the lines and heading into the horizon where they want to go.
That's awesome. You also have another project that, from what I understand, we've talked about it on the show before, but from what I understand, Dr. Gary has created an educational program. Can you tell us a little bit about the financial education that you guys have worked on?
Yeah, this is something Gary's had a big passion about, and the community where he is at, in where our office is at in Frankfurt, and even when he was here located in Virginia, he always was involved in um, financial literacy and financial education, investment education. So he will actually volunteer and go out and teach every semester at a high school locally. And he's teaching financial basics. So these students get to go in and they get to learn actually um, what a stock is, what a bond is, what a mutual fund is. We get on their radar about planning when they get out of high school, when they get their first job, what's important to do as far as insurance and savings and what kind of savings they can do. So we also offer he puts together a stock market game for these kids,
Oh,
which
wow.
is really great. So they can actually give them like fake money. You know, they have a certain amount of money that they can trade, and during the course of that semester, you know, they go back and see who won based on the trading. Now, again, you have to caution people because like they might treat it like gambling. You know, they can be out of money in no time, or they can be way too conservative. But the thing is, what we want them to learn when they do that type of game is, what did they learn about themselves at the end of the semester? Was I way too aggressive and needed to pare back? Was I way too conservative? They get a chance to kind of play around with it before they get into the workforce, before they go to college and have all these other responsibilities heaped up on them later in life. They've already kind of got a little simulation of what they're doing and the kind of people that they need to call on to when they need help or advice or guidance. So I think that's really important. Some states are actually starting to mandate financial literacy in high school. Commonwealth of Kentucky happens to be one of those right now. So I think there's a handful of states that mandate it. And I'm thinking over the next course of a few years, you're going to see a lot more states doing this. You don't see enough. Well, there's courses that are offered to teachers to how they can teach their students, but they're not investment advisors. And I would love to see more investment advisors donating their time, volunteering their time to go into local schools and help them understand, learn about financial literacy at a young age, get them thinking about it before they go and load up that credit card in college, you know, and they come out with debt and come out with a lot of student debt or mess up their 401k or leave their, I hear this all the time. They had a great job for a couple of years and left, and then they just cashed out their 401k
Mm.
and never bothered to start another one, you know, and I'm like, oh, you gotta think about those things because a couple $1,000s now and 10 years from now, you know, that grows over time, you know. So that's the opportunity cost. And that's kind of the big concept we teach is the opportunity cost. What are you giving up by not doing this?
And so,
And it hits home. Gary does a really great job doing that.
so I have a question about the program that Gary has put together for financial literacy for kids. Is it packaged in any way that someone could contact you and purchase it? Let's say they're in a charter school or they're on a school board or they're a homeschool parent.
We don't have anything packaged that they could do that with. Um, but it's something he would probably be willing to put together a template down the road for people to draw on, like teachers can draw on like how they could teach this and how, you know, private schools could teach this too. And um, you know, that's something that's on his radar of doing. I don't know when he'll get around to doing that, but yeah, it'd be a great thing. I don't know if we would want to. I know we got to get. We're in business. We're there to make money like anybody else, but that's a very important thing. I don't know if we put together a package like that, if we would want, we could digitally send it to people. I don't know if we'd want to sell it. We would just
I see.
offer it. Does that make sense?
It makes total sense.
So,
You know, it's something that for myself personally, looking in hindsight of the education or lack of education that I had in my environment within school for middle school, I think it should really start in elementary and go up through, but middle school and high school to understand any of it, right? You know, in my day, in the high school that I went to, and it was only one of the high schools I went to, they offered a home ec course. And so, you know, home economics, they would teach you about cooking and cleanliness and running the house. But they did have one small chapter that we studied on banking, how to write a check, you know, what's a routing number, you know, what's a
yeah,
savings, what, you know, what is interest. It was extremely basic. And I think that there's a lot of wanting and need to have the rest of the states mandate financial literacy, because it is so very important. And we've learned so much with you on the show, especially about, buying down your credit card debt, paying that off, because it's just exponentially growing inevitably. You could stop using the credit card, but there's still interest. And today, interest rates are sitting at 23, 24, up to 28%.
Yeah, that's ridiculous. Highway robbery is, it's amazing that I don't know. I guess some people have a lot of risk. They take a lot of risk offering credit cards to people that don't pay with default rates, and default rates are starting to go up. We're seeing that over the last year, but that kind of interest rate, no wonder default rates go up.
Yeah.
Yeah, you push people into paying the minimum payment, which is what they want, for as long as they can drag them out. Yeah.
Totally. I was having an interesting conversation with my mother this morning. She called me and we got off topic of whatever she called me about. And we were talking about the housing market and how we're definitely seeing the housing market in the bubble bursting in Florida. House prices are falling rapidly in the state of Florida. But then she started talking about interest rates. And, it was a long conversation about the kids coming out of college and what are their opportunities. And the younger generation of the 22, 23, 24-year-olds that are college graduates feeling a bit befuddled, just like,
Yeah.
I can't afford a house. I can't afford an apartment, much less a house, these types of things. And she was talking about the interest rates when they bought their house that I grew up in.
Yeah.
And I'm like, but Mom, you paid $75,000 for that house. So what if the interest rate was 16%?
Yeah.
5,000, and it was a 4-bedroom house. Like that's not even possible unless the house is like really to that point of condemned. It's like just falling apart, has no roof. Maybe you'll get it for $75,000.
Yeah. Yeah, back in the 70s and early 80s, the average house, it was right in that wheelhouse between $75,000 to like $95,000, and that was a high-end house.
Yeah.
And even when I was kind of growing up and I was in high school, somebody bought a $200,000 house. That's a big freaking house, that's a lot of house. But now 200,000 is like, it's amazing. Like, I don't want to say the amount, but my sister had hers appraised. And I'm thinking, wow, that's a lot of house, But when you have some property and a pool, outdoor in-ground pool, and all that, it's like it goes up. And I'm like, that is one heck of an expensive house if somebody wanted to move in that neighborhood. Because I don't think you can find anything decent in her neighborhood for less than 400 right now.
Well, see, and that's the thing. It's like everything inflated in the housing market so quickly. And we've spoken about it before. I'm in a particular area where there was room for growth, and there was a lot of new building happening. So we had the inflated prices, and then we had all of this new house developments coming up, and they were selling out at the higher inflated rates. So it just doesn't seem like in some of these areas that the house prices are going to come down. But I'm curious about what you're seeing with the feds and the interest rates. What are you seeing so far? What do you think is going to wind up happening, for the next quarter? I mean,
it's the Fed's fund rate. It's stuck to like 5.25 and 5.5, right around there. It's 5.3, I think. And of course, rates in the market, the 2-year and the 10-year, those bonds, they will float, based on supply and demand and the economy and what people are, putting in those, and the yields on those are lower than so short-term yields are higher than long-term yields. And it's really frustrating because now you have the government that has to service all this debt that they issued out at higher rates. That unfortunately it's going to put a damper on the economy. The Federal Reserve right now, we're starting to see some cracks, I guess, in the economy a little bit. Not that we're looking at a recession, but a hard recession, but there's the job numbers. You're starting to see some unemployment numbers go up and consumer sentiment's going down, and then the inflation number is still a little sticky. So they're between a rock and a hard place right now. They're not going to raise rates, but they're not going to lower it either. Not anytime. I don't think before the election, because the first of the year they were talking about possibility of 3 rate cuts. And, even then I was like, I don't know. We'll see how sticky inflation is. And the first 3 months, I mean, you had a couple of good numbers back to back that came out okay. And then the numbers trended a little higher, the inflation number, month over month. And I mean, it's come down a lot, but we're still 20% higher than where we were when the Fed kind of was behind the 8 ball trying to stop inflation after all that government spending
Sure.
back in 21. That was about half of that was quite unnecessary. And so now we have this inflation that's sticky, and it's hard. Are they going to bring it down to 2? Hopefully eventually, but inflation still keeps going up every year, even if they hit their 2% target. But we were talking about before about the price of eggs and things at the grocery. It's just from 3 years ago. It's just incredible what people are paying, and even the prices at the pump. So if those prices, energy costs don't come down at the pump, then you're not going to see. I mean, that would help bring overall inflation down a lot. But I think rates are going to stay right where they're at through the rest of the year. I know there are some that are saying that maybe 1 rate cut now. But this is the cynic in me. When you're investing, when you're in this business, you kind of hope for the best, but sort of sometimes plan for the worst.
Mm-hmm.
And we're starting to see a little bit of market volatility under the hood a little bit that a lot of people kind of don't see right now. But it's the Federal Reserve if everybody trusted the Federal Reserve to keep inflation at bay, and they were so far behind the curve that they dropped the ball and and this got out of control up to as high as 10% at one point.
Yeah.
Do we have much trust in them that they're not going to break the economy with their rates, at some point too, and cause a recession? Because everybody's still saying, "Oh, we still have a soft landing. We don't have a recession in the cards or in our outlook." But a lot of the analysts that like Morgan Stanley and Bank of America and all those, Goldman Sachs and all those. But I just, in the back of my head, like I just kind of don't trust them to not drop the ball this time either going the other way. So if we do end up with a mild recession at some point, it would not surprise me if they left rates high a little long, and you started seeing cracks in like regional banks, for example, and small businesses that really can't handle higher rates for this long.
Mm-hmm.
Which in the grand scheme of things, if they hadn't left rates at almost zero for like 10 to 15 years,
right,
it wouldn't be a deal. We would be used to having something, but we went from 0 to 5.5 in like no time. And that's not going to be helpful at some point. Something will break eventually. And I hope I'm wrong, but in the back of my mind, I'm like, okay, how do we plan for when that happens again? Because eventually another recession will come around.
Mm-hmm.
It's just this cycle. So when everybody looks at how great the market is and how wonderful things are doing in the stock market, that's when I start thinking, okay, let's start looking at the other side of the hill. And then how do you prepare, slowly going forward? You don't want to be reactionary with anybody's money. And if you're investing on your own, you definitely don't want to be reactionary with that, because it's kind of dangerous to do that. So you just have to plan ahead and have a strategy and have something that you're willing to implement over time to adjust for that. So and minimize your risk at the same time.
So, I'm kind of curious about something. I've been looking in the news, and from what I can see, which I don't watch this day in and day out like you do, you're a professional in the financial world. But as of right now, from what I understand, stimulus for the economy, stimulus checks to the American people are not in the works for 2024. However, it's an election year. And if we're looking at the same 2 guys that we had to pick from 4 years ago, I think it's just going to get more and more and more aggressive to try to win the votes, if you will. Do you think there's a possibility that we're going to see some stimulus money that I don't know where in the world they get it from? I just go get from the money tree and start pulling dollars off or something. But do you think they may try to do something like that, which in my mind, and I'm fairly uneducated, I'm learning within the financial world, but it's not, my brain, so to say, it wouldn't help it's not going to help inflation to flood more money
No,
in.
no, that'll just make it worse. So I think what the next administration needs to focus on is reining in our budget and being a little bit more pragmatic with our spending. I know a lot of people don't want to like that. They don't want to like that at all. But um, but a couple things they're already talking about to kind of prime the pump, so to speak. Trump is out there, campaigning hardcore out in like Vegas and
Mhm.
Philadelphia, and everywhere he's at, he's going into blue collar and like service companies, restaurants, things like that, and talking about vote for him if you don't want your tips to be taxed. He wants to eliminate the tax on all tips,
Mhm.
which I think is a great idea. Like I don't. There's not many taxes I like, so to put it that, because people work hard for their money to have half of it taken by governments. So
Well,
um,
but you know what? I've worked in the service industry. I was in the restaurant industry for 4 or 5 years or so, some of which I was on the serving side of it. So I did earn tips. And has it really changed from when I was doing that 20 years ago? Because we only had to declare 35% of our tips. Do you now have
I
to
don't
declare
know.
50?
I'm not sure what you have to declare now, but I do know that at some point within the last like 15 years that there was a change, because I knew some people that worked in the service sector that they were upset the way their tips had to change, and I really didn't ask and get into it. But even if you're paying 30% on your tips, that's still 30% of your money. That's
It is.
instead of getting $170, that you take home instead of 100. So I mean, I still think that's probably a good idea. But he's floating that, trying to get as many votes as he can. And on the flip side, Joe Biden, every chance he gets, he's talking about forgiving student loan debt,
Yeah.
which is pandering, to his audience as well. Which is again a form of stimulus, really, when you think about it.
Oh, it's
When you're cutting tax, or anytime the government spends money, it's stimulus. But it just depends on the way they structure it. And yeah, I don't think anybody's going to get any kind of stimulus checks this year because one, there's no pandemic or anything like that, or any kind of. They're trying to talk. One side's trying to talk about how the economy, people are better off financially now than they were 4 years ago, and the other side's talking about all the inflation that eroded people's earnings. Right. So the House of Representatives still in control of the Republicans, even though it's a slim majority.
Mhm.
I don't see any chance that they would pass a stimulus out of the House,
Okay. So,
even if the Senate wanted to.
with the no tax on tips, I have to say, if we're to postulate over like what persuades each one of us to which party, that it really does nothing for me, because I do feel like if we spotlight, no taxation on tips, now we're at Kroger and you have to select, do you want to tip your cashier? And it's like, I'm self checkout. Who am I tipping?
Yeah,
I go into the auto parts stores for something for my car. Do I want to tip the cat? No, I don't. So I think we'll
yeah,
probably see a lot of that on the kiosks of asking for tips. And I think some of the older people, the elderly people, should be watching out for it, because it's just going to be a slip of the finger and you hit 20%. And now all of a sudden you just added 20%
yeah.
onto a bill for some whatever item that you would never tip anybody onto. So it's sort of like, I don't know, that doesn't do it for me. Um,
You know what would do it for me? If they would cut like say grocery tax or the gasoline tax, that then you're talking to me.
yeah.
You want to cut personal property taxes? Yeah, you're talking to me. At that point, so
I saw something.
that'd be
I have to ask you about this. Now that you said property tax, I saw a video today. I haven't had a chance to research it, but the basic idea was, if you don't want to pay property tax, then when someone that you are connected to, close to, let's say your mother, a spouse, a sibling, dies, you bury them on your property, and then no state, none of the 50 states can tax you on your property because it's a burial site.
yeah. I saw that video and I watched that and I was shocked. I don't know if that's true, but I'm sure going to find out. because
I know.
because it's really where I live out here in kind of rural, middle of Appalachia. You drive around and sometimes you'll pass people's property and you'll see little family cemeteries on their property.
Yeah.
And that's not uncommon. That's like you probably saw that in parts of North Carolina. So it's not unusual. So I wonder, that made me wonder. So I'm going to find out. That's really interesting. Not that I'm going to bury anyone in my backyard, but if my cat can count, does my former cat count? Like like I don't get way property taxes.
You know what? I'll do it. I mean, both my parents want to be cremated. My dad's kind of on the fence. I'm like, I'll take Dad. Come on. I can dig. I'll take Dad. I mean, that's a lot of money if that's really true.
Yeah. Oh yeah. I mean, because even around here, like depends on which neighborhood you live in. You might need to pay anywhere from $600 to $1,100-$1,200 a year in personal property tax just on your home. And I don't know what it's like in Georgia, but every year I have to pay personal property taxes on both cars, even though they're paid for.
Yes.
Every year.
Every year.
That's almost like not just double taxation, but triple, quadruple. It's like at some point you're like, dude, the value of this is not worth all paying taxes every year. But it's kind of crazy that there's so many taxes. You could list all the taxes out. It takes 3 or 4 pieces of paper to list all the taxes that are out there. It's ridiculous. And we had a revolution over a 2% tax.
Yeah. Oh, I know.
What's wrong with
you have educated us in the past, and I just want to brief over it really quickly. I know that there are investments that you can put money into and you can allow them to grow. And after a certain age, you get around some of the taxation. What would be some of the top investments for someone that, wants to put some money into something, possibly let it grow, mature, whatever, and get around taxation on that money that you've already earned? So you've already paid the taxation of earning the money, and now you you invest it.
Well, one of the things that you could do is, we've talked about a Roth IRA before.
Mm-hmm.
So if you've built up money in a traditional IRA and you've got your tax deductions, right, so that you can always convert those. Like if you don't qualify for a Roth IRA anymore, you can convert a certain amount of that you're comfortable paying taxes on, knowing that later on you don't have to pay taxes on it. So a lot of wealthier individuals will do that. But yeah, Roth IRA, you've already earned your money. You can put your money into a Roth IRA. You can do up to $7,000 a year, and just let it grow. And then when you take it out at retirement, it's tax free because you didn't take your deduction like you would in a traditional IRA. Now, also, if you have an employer that offers a 401k, some of them now are offering, or quite a few of them now are offering Roth 401ks. So it's the same thing, but you don't withhold from your paycheck. It's after taxes that money goes in. And now the employer, unfortunately, I don't think they get to match like they would with a traditional 401k, right? But yeah, I've known of folks who had a 401k that was a Roth style, and same thing with a 403b if they worked for a nonprofit or like a school or a hospital or something like that offer those too. Those are great ways to put money in and just let them grow tax free. Roth IRAs, you have those minimum required distributions you have to take at the age of, I think, 72 and a half or 72 or 73 now, but it used to be 70 and a half, but they've increased that. But Roth IRAs, you don't have to take distributions from those.
Yeah.
Just the pre-tax, the stuff that you did, because at some point the government wants their tax money, but Roth IRAs, they're not getting any benefit, so you can just keep that growing. The other thing, if you really, if you have a lot of assets and you want to consider that, you might want to do some research in a general way on estate planning, because there's a lot of things you can do to, I guess, be a little bit more tax friendly in estate plans. But that'll take somebody working with an advisor to review all of your holdings, not just your property, your homes, and everything else like that you want to include in the estate, and then estate planning attorneys that can come in and develop that plan for you and save you a lot of money. If you're wealthier and you want to pass that money down to your heirs, especially estate planning, if you want to pass along to heirs with your stipulations, not if you die, then it's whoever gets it. You can actually set the rules on how they get those distributions going forward before you die, which is a big deal for, especially families in the upper middle class.
Mm-hmm.
Yeah, and then higher. Yeah, because you don't want to save your whole life and just watch your grandkids piss away everything. Two trips to Tijuana,
Right.
come back with two kids they had. So you don't want that kind of situation. But you can actually have stipulations based on they get a certain drawdown, a certain percentage drawdowns, kind of like an endowment in a way.
Oh,
but it could be but you can structure it to be very tax advantaged.
so are there any new laws or possibly upcoming laws that would affect people of retirement age, extending the retirement age, anything like that? Are there any new things to watch out for that there's some grumbling of new laws coming?
Yeah, there's always talk about extending the retirement age and for Social Security and things like that. So that's always, of course, anytime you have a political season, you always have that argument about, well, this side wants to cut your Social Security, this side, wants to eliminate it, whatever. But so there's always those grumblings, and occasionally a bill will get introduced, but usually in the finance committee, they all get shut down. Because one of the things I've learned about over the years watching these new laws and regulations that get suggested, and sometimes they might be good suggestions or might be fiscally prudent, but I think you come to understand that a lot of these people that are in office, they get a lot of their money from lobbyists who are willing to fund their campaigns. And of course, there's some big financial lobbies on Wall Street, big pharma, there are all these people. So getting any kind of meaningful change is a tough thing to do. The last real changes we saw, I think, was the first year of the Trump administration. And there were a lot of common sense things like this changing to extend the minimum required distribution age, and things on like spousal retirements. Like if somebody, a spouse had passed away and then, the wife inherited or the husband inherited the 401k, you'd have to draw it down over 10 years. But now you can, like certain rules like that, you can extend it to, when the husband or wife, when the deceased would have retired, you can extend it out to that now. So if you lost your husband or wife in their 50s, then you can still let that money grow for 20, 25 years before you have to take it. Whereas before you couldn't, so there's a lot of changes and just laws like that had changed, but nothing that I don't think on the near horizon. But if I hear of one, I'll certainly let you know. There's because those types of things, you have clients that have traditional IRAs, Roth IRAs, business accounts, SEP IRAs for their businesses, all those things. So yeah, any of those changes you got to stay on top of. Otherwise somebody else pays the price. That's
right.
Yeah.
So I was looking at the stock market. Obviously, today is Monday, so it's just opening. It seems to me that whenever I do check into the stock market, Monday can be kind of a rally, but it doesn't necessarily set up how it's going to play out for the rest of the week. But today was pretty good, right?
Yeah, it wasn't a bad day. The Dow Jones was up a good bit. I think the S&P might have been down a little, then the NASDAQ down about 100, which is, considering where they're trading at, the indexes, it's kind of flat, but the Dow rallied today and did really well, which is just 30 stocks, 30 companies in the Dow Jones average. So I tend to look a little bit more at the S&P 500. But yeah, Mondays are busy days. You have a lot of people that maybe didn't do any trading going into the weekend, come into Mondays. They sort of try to get their business done, for the week. And so Mondays are usually heavy volatility, not volatility, but like volume days. So that's when you see generally a lot more trading. But that doesn't mean that's the heaviest trading. It just depends on how the week goes and what news breaks and that sort of thing. Especially when you're going into earnings season. We just wrapped up with corporate earnings for the quarter, and it was a good quarter. So they just on the side, what I saw today, look, even though the indexes were good, you saw some selling. of those. We talked about the Magnificent Seven, those top 7 stocks that have just outperformed the last 2 or 3 years. Your Facebook, your or what Meta as it's called, and then Google or Alphabet now, Apple, Microsoft, Nvidia is a big one that with AI that everybody has just been running into left and right. And you're starting to see. We'll have to keep watching to see if this pattern continues, but June is generally an interesting time because they always refer to it as the summer doldrums, like things sort of slow down, but in the summer and then pick back up in the fall as far as volume of trades, but a lot of nonprofits and businesses, their fiscal year ends in June. So they're reevaluating and reallocating their assets. Big pension funds, for example, will be doing the same thing. So I noticed a little what I call rotation. So coming out of those Magnificent Seven, especially Nvidia was down a good bit today, but going into other things, like they're just kind of rotating out and moving into other sectors of the market. So that's when you see like more broad-based S&P doing really well, and some of the small caps doing well. Corporate bonds, lower grade corporate bonds, I've noticed that. So there's a little bit of rotation going on. You may see that for a little while. It wouldn't surprise me if you saw some of that money come out of those big cap companies that have done so well, because people are, at some point you got to ring the register and take some gains. Normally I wouldn't even hold anything as long as some people have, because I make a certain percentage. It's like, do I want to be greedy and see if it goes back down, or should I go ahead and take profits for my clients and move on to the next thing? So, but yeah, I sort of noticed over the last few trading sessions some rotation coming out of that. But will that hold up? I don't know. Well, it's just one of these things I'll just keep watching and see. And it's not a bad thing. People have to take profits, and that's okay. Nobody hurt themselves making money. So, just to be cautious though, if you're looking to go in the market, and especially if you're looking at those big names like that, maybe just keep your powder dry, so to speak. You keep some cash on the sideline and see if you can get a better price in a couple of weeks or so. And if they don't rotate out, then if you're a long-term investor, whether you buy this week or next week really doesn't matter in the long term.
Right.
So just kind of consider that. But if you're looking for an entry point, it might be worth it to kind of watch for a few days.
Okay. All right. So I know that we had talked in the green room that you wanted to talk about dips. And
yeah,
can you explain to us what is a dip in the market?
Yeah, it's one of the things when I first got in this business, you hear all this, I guess, jargon, industry lingo, and in your work you use certain things that clients may not understand, certain terms. So like understanding the language of the stock market's kind of really crucial for investing. So I was told early on to kind of simplify things, explain things so that they're very understandable. Right, like I would be talking to my mother or my father, right? Just, that doesn't work in the industry, right? Or has no experience with it. But buying on the dips is one of these terms I've never really found another way to explain it. The concept of buying on the dips, though, is if you believe the market's going to, some people that are bullish think the market's going to continue to rise, and so buying on the dips is something that a bullish investor would do. So if you're one of these people that thinks, hey, the market's going to sell off big, well, you're not buying on the dips. So if you're in that camp of like gloom and doom, this is not a strategy for you. So I'm just going to throw that out there. Buying on the dips is you believe the market is still theoretically going to continue to go higher over time. So essentially buying on the dips refers to you purchase a stock after its price has decreased or dipped, right? Because of something. Could be some breaking news, or they missed an earnings report, for example. And I've noticed a couple of bigger companies that missed their earnings. I'm not going to name any names, so they're not necessarily a recommendation, but if a company missed its earnings report, and not by much, and if that stock, I noticed one of them sold off 25%. And I'm looking at the fundamentals of the company. It's making money. It just missed its earnings. So that expectation was built in that if they were going to hit their target. And then when they didn't hit the target, people got disappointed and sold off the stock. Well, I can understand some of that, but selling off 20%, yeah, did that make sense, right? So buying on the dips would be looking at something like that and thinking, okay, I'm bullish on the market, I'm bullish on this company for the long term. I'm willing to buy on that dip and hold in my portfolio. So that principle itself, it's very basic. It's like, the principle of buying high and selling low, or buying low and selling high. That's how you make money in the market, right? So it's that same fundamental logic, but it stands in contrast to like bearish investors that think, hey, it's down 20, I think it's going down another 10 or 15. Buying on the dips is a lot. It's not trying to time the market. So I want people to understand that. If you have a company that you really like and it's dropped a certain percentage and you're willing to buy it and hold it for the long term, because this is a long-term strategy, not a quick trade, right? And so, you can look at it and say the downtrend is going to be short-lived, you might think. And short-lived maybe a couple of weeks, couple of months, couple of quarters. You don't know, but you're willing to hold for the long term. So I always look at those types of things as opportunities. When I see something that's sold off a significant amount, I'm going to go pull that company up. I'm going to go take a look at that quote. I'm going to pull their fundamentals up and look at it and see if it's something that might be worth buying, for myself or a client, or and holding for a while if it fits their strategy and their time frames and horizons and all that. So basically it's saying, hey, this thing's oversold. This company sold off way more than it should. I'm going to take advantage of this. I'm going to buy it now. I look at it like this, and this is a very simple way of looking at it. Just take stocks off the table for a minute. Let's just say you go to the store you like to shop, and you see this really great dress you want, or a really great purse, right? And the purse is $250. And it's like, it's really nice. I'm going to think about it before I buy it. That might be a fair price to you, but sometimes with a bigger purchase, you might think, I'm going to wait a day. So if I want it that bad tomorrow, I'll come back and get it. Like I kind of do that sometimes with things. I'll think about it for a couple of days. So I still want it. I'll go get it. Sorry about that.
That's okay.
But if the price comes down, if they put it on sale tomorrow, and you go in and that dress is 30% off, or that purse is 30% off, or now it's 200 or 180 to sell, like that's a bargain. So that's the way you look at it. Like, I'm willing to buy something on sale now, even though I didn't like the price, but now it's on sale, I'm going to buy it. You got to look at stocks the same way, these companies. And again, I don't necessarily like to think of them just as stocks. You're buying a piece of a company, so you have ownership in that company. Are you willing to own it? And if you're willing to hold it for the long term, sometimes I like companies that'll pay you a little dividend. Like, I like to get a little something while I'm waiting. Okay. Sometimes if it's a growth company, they don't pay those dividends. If the long term, I feel comfortable in the long term that it's going to do great, then I'll buy it. So you got to look at that. But it's two different things you need to look at, though, when you're looking at those companies. There's two different types of analysis, and this is where, if you're doing all this on your own at home, this is kind of what you need to know. You're going to do two types of analysis. One is fundamental analysis, and that's where you're actually looking at the financials of the company, the balance sheet, the income statement. You're going to look at their future financial projections. What are their sales? Look at all those ratios that you heard about in finance class in college. You're going to go look at those things. And you're going to see if that company is at a fair price, or or a price that's on sale for you that you're willing to buy that at. Now, that's the first thing you want to do, is fundamental analysis. But the second thing you need to do when buying on the dips, you need to look at the overall market. So you just kind of need to be cognizant of the entire stock market. Is everything selling off? Are we in a short-term correction? Not a bear market, but a correction. Sometimes stocks run up, people take gains, the market drops 5, 6, 7%. That's a good entry point. That's buying on the dips. So are you comfortable that the overall market, and I guess the economy, but the overall stock market is still in an upward trajectory? It's not in a bearish trajectory. You don't think it's going to continue to go down, but at some point around where you're at, it's going to stop. This is not trying to time the market, because no one knows the bottom and no one knows the top. But if you look over time, the stock market, the trajectory of the stock market is up. So over the long term. So it's just a matter of, are you willing to take those short term cycles of volatility when things sell off to buy on the dips and hold for the long term. So it is a long term strategy. It's not one of these short term trades you're going to do. Not to say if you buy something and it shoots back up 20%, you don't take your profit. That's, sometimes you don't want to look a gift horse in the mouth, right? But at the same time, that's kind of what you need to consider. And that kind of goes in hand with something we talked about. One of the lessons before was dollar cost averaging in a little bit every quarter, every month. If you have a 401k and you're adding to it, you're already doing this. So if the market's correcting, you're still buying on the dips. You just didn't realize what you were doing by dollar cost averaging, because you don't know where the bottom is, but you don't know where the top is. So you just know that you're comfortable with the market going up over long term. But that's the concept of buying on the dips. Make sure you're comfortable that it's still a bull market, not a bearish one, and you're in for the long haul. And do your homework. Definitely do your homework.
Is there a list of a couple of websites that you can think of that you regularly use to try to do some of your homework?
Well, since I'm on Schwab's platform, I use them quite a bit. Fidelity is another one that I've used. There are some, Yahoo Finance is not that bad. Actually get some good, tools over there for research when it comes to using technical analysis. Like, that was the other thing, the technical analysis you have to watch, and by technical analysis, let me just kind of jump back there real quick, because we had fundamental analysis, technical analysis. Technical analysis is looking at the chart and are you noticing trends? And there's certain things that you can spot in the trends, and you have to have experience in technical analysis to spot certain trends by the way the charts are flowing, because you can spot an uptrend or a downtrend, when something may have bottomed, when something may have peaked, based on the things that you look at. One of the things that I look at to see if something maybe has been oversold is a statistic called relative strength index, or RSI. If you're researching on like big charts or something, or market watch, and you're looking at a company or CNBC, if you look up RSI, relative strength index, it'll tell you if according to their analysis, if that company is overbought or oversold or fair valued. So that's one thing. I don't get too technical, but another thing I look at are these things called Bollinger Bands. So you can maybe just do a Google search on Bollinger Bands if you're jumping that far into technical analysis. Basically, it shows, the middle line shows a trend, the top line shows kind of the outliers on the top, and the bottom line shows the outliers on the bottom. And then you can look and see where a price change in that stock falls within those bands to determine if it's overbought or oversold, and where it's at in that trend. It's kind of a little complicated, unless I had like a chart showing it, can like stand there with a hat on and like a little, my clipboard and point at it. But that's another thing to take a look at. There is risk to it, though. I mean, if you're not going to be willing to hold it long term, it's not a foolproof strategy. If you're going to buy something and it drops another 5-10%, it's like, oh, I'm out. Well, if you really like the company, maybe you should add more, if you're bullish long term, instead of, because people tend to be reactionary, so but if you're doing that, set some hard and fast rules as to how much you're willing to lose, or you don't lose anything till you sell. So it's, people understand that, but how much you're willing to see it drop even further before you're willing to get out. And don't wait till it's 20, 30, 40% down. You might have a rule that if I buy something and it's down 10% and I'm not long term, I'm going to get out. Or if I buy something and I'm not willing to hold it long term, but it's up 20%, I'm going to take my money and walk. So have some rules of thumb like that for yourself. But it's it's more than just buying stocks that's dropped in price. There's a lot to it. But I did want to introduce the concept because it's something people do a lot of times, like I said, in their 401ks, and just didn't realize they were doing it.
Interesting. Well, thanks for sharing that with us. In doing your research and just, what you were educating us with, some of the things to look for, I just have a really simple question that I think is on the minds of the general population that isn't as educated as yourself. We have heard through the news cycles that some of the major brands here in the United States are either closing stores or closing altogether. How do you think that's going to affect the stock market? Obviously, I can deduct that that's bad. It's not going to be good. But what do you foresee could come from that? Because we're talking about brands such as Walmart, major drugstores, dollar stores, you know, a lot of these stores that are on just about every corner in every town of America.
Yeah, and a lot of them have closed down. And one of the reasons they say they're closing down is because of, I guess, lack of security. They're in dangerous areas where they see a lot of theft, and they don't want to take that much theft. They're just going to close their doors. That's lost revenue, but that has to be offset with lost, money that's stolen or items that are stolen. So it's always a bad thing. It's not a good thing when you see those companies closing down. So if you look at, say, for an example, a mutual fund may have, I don't know, it depends on the size of the fund. They may have 5 million shares of Walmart. That's a lot of Walmart.
Yeah.
And if Walmart happens to take a hit in revenue based on the way people are trading the stock, and especially these big institutions like mutual funds and pension funds that trade, they move the market a lot more than you and I are going to move the market. Right. So because they just have more to deal with, but they can only sell so much at a time because they can't crash a company. They have regulations on how much they can do per day. But yeah, it's generally it's not a good thing. That's why, when I was bringing up earlier about the overall economy, if we did see a recession, rates are high. That's hurting small businesses. It's hurting mid-sized. Actually, it's hurting a lot of businesses. The big mega caps don't worry about it, but Walmart's not worried about what interest rates are.
No.
They worry more about inflation because they have to keep prices low to keep in business. But if the market got a little choppy over the summer, it would not surprise me.
Okay.
But then again, that's one of the reasons I wanted to bring up the topic of buy on the dips. Know what you own and why you own it. Just be comfortable with that company, because there may be some opportunity. I'm not saying there are. I'm not predicting anything, but there might be opportunities in the next few months to, if you have some cash available, to buy some things that may be on sale. Not that we're going to have a bear market. A correction is anything over 10%, between 10 and 20%. When an index drops over 20%, that's a bear market. And I use that same concept for individual companies too. If it drops over 20%, that company is in bear market territory. So that eventually, when enough of them have that problem, that eventually flows through to the indexes like the S&P and the Dow. But earnings have been good for a lot of these companies. I think 71 or 72% of the S&P 500 actually met or beat earnings this last time around. But it's just one of those things when you see where rates are at, and it's kind of what's going on with the general economy. That's why you sort of have to see kind of the big picture too sometimes, because the stock market is a forward-looking beast, right? So if we're going to have a recession 6, 8, 10 months from now, you'll probably have a market correction 6 months before. And then by the time the market starts coming out of it, the market comes out of it when people start going into a recession. Does that make sense in the economic sense? So it's always sort of forward-looking. It's never a uniform thing. It's to tell this time frame or that time frame. The thing that has concerned me most, though, is the 2-year and the 10-year yield. We talked about that before. The yield curve, if it steepens, that's a great sign for the economic growth. But it's been inverted for well over 500 days.
Right.
And it's just that little nervous tick in me always says, just kind of be careful, just be on the lookout. And my job is to find opportunity for people, and sort of I know we're going to stay invested long term, because jumping out of the market when it sells is one thing, but most people, when they do that, don't get back in until after a rally because they're nervous and stay out. And there's statistics you can find. I'll look it up for the next time we do a show, that if you miss the 10 best days in the market, the difference between staying invested and trying to time it is huge. So staying invested in the long term is very important, because just missing those days makes all, it's like that compounding effect times 10. So you want to make sure you're in it for the long term, but keep some cash dry and keep some powder dry for times when you can take advantage of dips or bear markets or recessions. I know it's hard to say, but you don't make money buying high and selling low.
Mm-hmm.
And when things sell off, like after that great recession we had back in 09, people were jumping in. I mean, I can't remember how low Delta got, but if you'd have bought Delta at like $5 or something, which you could have, it held it, you'd be trading at 46, 47 today.
Right.
Yeah. So, yeah. So it's just a matter of, you gotta have some stomach for it, but this is the long term. Stock market over time, the trajectory from going back 150 years is clearly up.
Mm-hmm.
Even during the Great Depression era, you'll see the blips, but those bad market years. But yeah, it's just be comfortable with what you're doing, and if you need help with anybody, definitely touch base with an advisor, or you're welcome to touch base with me, and we'll talk about your situation and what you need, what you're looking for.
Yeah, I was just about to ask you if you could close out the show with how everybody can contact you. I know that I do have your website and your email address scrolling at the bottom, but how much money do I need to have before I call you?
You know what? It doesn't matter how much money you have. I don't care where you get started at. I'd care more about where you finish at. So if you're starting with something as little as $500, you can call.
Wonderful.
Or if you have a couple hundred and want to get started and want to do like a monthly 100 or whatever, let's get you started, because you're not going to win the game if you don't step up and start playing. So that's the thing. It's life is precious. But I will, vistafrontpartners.com is the website. You can email me directly at jc@vistafrontpartners.com. Our phone number is there on the website as well, under the Contact Us tab. And once the clients that we have, we take them through Charles Schwab. And there's a link there on the page that you can click on and actually take you to the Schwab portal to log in and view your account when you want to. So we make it a little easier for you there too. Instead of just getting your statements, you can check in anytime. And I just want to kind of remind people, though, we talked about this a lot, with so much going on in this world, and so much stress that people deal with jobs and saving, and they have kids. How do we save for college, or how do we save for private school, or all these things that you need to plan for: first home, retirement, vacations, like anything at all. Just keep in mind that you're thinking about it. Take some steps to do something, and you're doing okay at that point. Just tell yourself you're doing okay at that point, because you're not gonna, as long as you're taking steps to make things better and planning for the future. There's so many things in life that make us rich that have absolutely jack and squat to do with money.
Yeah. Oh, JC of Vista.
Sorry about that. I keep getting calls coming in here.
It's okay.
But yeah, just to remind people, every day is a precious day. Treat it as such. And like I said, there's so many things that make us rich that have nothing to do with money, but we have to prepare. So let's make sure we do so.
Absolutely. Well, thank you so much for your time, and I hope to see you again very soon. And this is always so enriching to have a few moments with you, a few teaching moments with you, and you're so very giving to give out this education for free. So thank you so very much for your time, JC.
Hey, well, thanks for the opportunity to come on. I appreciate it, and I appreciate all you do too. So I look forward to coming back. We'll have fun next time too.
Yeah, let's do it. All right. Have a wonderful evening, JC.
Good night, everyone.
All right, everybody. Thank you so much for staying tuned. Make sure that you like and subscribe, especially on YouTube. You can also find us on Amazon Prime Video. Just Google us and it comes up. But I really appreciate everybody who stayed connected and watched another episode of the news. As always, we are blessed. You are blessed. Mwah. I love you. And stay tuned for another wonderful show. I'll see you soon.